Good to see you. And let's start with those rising tensions in the Middle East, Sean. I'd imagine you're getting questions from clients today. What have you been telling them?
Well, what we've been telling them is welcome to October, right? There's always a season of volatility here, and you never know where it's going to come from. And now we're seeing it with these geopolitical and macro tensions. And the war in the Middle East is certainly escalating, and we're waiting for an impending response from the Israelis. And depending on the strength of that response and how it looks, it could really set the table for the rest of the month.
It could, Sean, but at the same time, we've definitely seen this movie before in the sense that you get a geopolitical event, you get sort of a reaction in the market, then it fades, and you don't really see the market react after that. What would have to be different here in order for there to be a bigger or more sustained reaction?
Yeah, I mean, I think it's pretty clear. It's one clear event. If the Israelis decide to go after the Iranian oil infrastructure, specifically at the Karg Island oil terminal, that supplies about 7 million barrels a day of oil coming out of the Persian Gulf. If the Israelis really are saying we've taken the gloves off and we want to cripple the Iranian economy, but we don't care about spiking oil prices, that's going to be their number one target. And if they do that, sort of all bets are off the table as far as what the oil price is going to do and how energy prices are going to react.
Sean, let's switch gears, talk about some of the economic data we got today. ADP came in better than expected. Of course, we have the big jobs report on Friday. What are you looking for there, Sean? How important is that?
I think it's everything, right? The Fed is, been really in this inflation battle for some time now, and kind of decided that we're cutting rates and we're moving forward. But I think the big driver behind that's been weakness in employment, right? Unemployment's ticking up at 4.3%. If we see a couple other issues with inflation, though, with this longshoreman strike and with energy prices going up, the Fed could be really caught between a rock and a hard place. So, the Fed gets caught between this dual mandate at times like this, maximum employment and price stability. So all eyes are going to be on this report to try and figure out what maximum employment looks like for the Fed.
And Sean, I know you're really focused on affordability in this economy, right? There has been a lot of economic ink spilled, so to speak, that the economy is doing okay, but that indeed lower income folks are struggling. How do you think about that, and how does that inform your investment strategy?
Yeah, and really, it's just not lower income folks. I mean, I think it's 2/3 of American households are really on the precipice of an affordability crisis. When you look at the cost of housing, when you look at the cost of food and energy, when you look at the cost of the basic needs for people, the price spikes we've seen over inflation over the last 4 years, even though inflation numbers have come down, but inflation is just simply the rate of increase. So we've seen these massive spikes in basic needs, basic goods for people over the last couple of years. People are still recovering from it. Just because the rate of increase is slowing doesn't mean it's getting any better. If I put on 10 pounds a couple of years ago and 12 pounds the year after and 8 pounds the next year and only 3 pounds last year, well, I'm putting on less weight, but I'm still 30 pounds heavier and I'm still unhealthy.
I'm just curious, that figure that you cited, 2/3 of Americans on the verge of an affordability crisis. How do you define that? What does that mean?
So if you let's just take the housing market. So some estimates say that there's over 4 million households, 4 million people looking for households that can't afford it, right? There's 4 million people that want to buy a home, that have enough for a down payment, but they simply can't afford the principal and interest payments. So if we see mortgage rates coming in, they'll be able to get into the housing market. But it still remains to be seen that if real estate's really the real estate market's going to open up for these folks, if they're going to be able to have access to funding and access to mortgages. You look at food and energy prices, you look at the cost of healthcare, you look at the cost of secondary education. All these things are seeing record highs in a short amount of time. So I think it's more the price shock. It's how quickly and how rapid these prices have risen is what's contributing to this crisis.
Let's talk politics finally, Sean. We had the VP debate last night, Vance and Walz. How are you thinking about election risk?
Yeah, I mean, I think that's always a risk that we always look at every couple of years. I think it tends to be kind of overestimated. Look, betting against America has never been a good idea since 1776. So I think in the long term, things will be fine. And, the stock market in terms of where we're looking at now, we're at near all-time highs. We're at near all-time or historically high PEs, and we're also at historically high revenues. So, the market's in a good place. Revenue growth and revenues for the S&P 500 will continue to drive the market. The corporate tax cuts that we've seen over the last administration, if they expire and they want to raise corporate taxes, that will go directly to hurting corporate profits. So that could be a potential red flag. But other than that, I wouldn't get too concerned about who's in the White House.
Sean, thanks a lot. Appreciate your time.
Thank you.